Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're digging into the second quarter fiscal year 2025 earnings call for First Watch Restaurant Group. That call was back on August 5th.
Yeah, and it definitely made some waves initially. There was this, significant pre-market pop for the stock.
Right, but then things getting a bit more, let's say, mixed during the actual trading day.
Exactly. So today, we're going to try and unpack why that happened. We'll focus on what looks like strong operational performance, but also, what's coming down the pike.
Okay, sounds good. Let's start with the headline numbers for Q2, because they kind of set the stage immediately. You had GAAP EPS reported at just 3 cents, which was a pretty big miss versus the consensus estimate of 7 cents, like a 57% miss.
Oof, yeah, that's significant. But then on the flip side.
Exactly.
Right.
Revenue came in at $307.9 million. That actually beat the street's expectations slightly, and it marks a really strong 19.1% jump year over year.
And that's the tension, isn't it? Strong top line, but pressure further down. Adjusted EBITDA was $30.4 million, which is, down from $35.3 million the year before.
Yeah, and net income landed at $2.1 million. We also saw the restaurant-level operating margin get squeezed. It compressed to 18.6% from, 21.9% last year?
Right, 21.9%. So, yeah, definitely a bit of a mixed picture on the profit side. You can see why the market reaction might have cooled off a bit after that initial pop, people reconciling the sales growth with that profit hit.
But okay, here's where it gets really interesting, and probably where that early enthusiasm came from. The operational wins were pretty undeniable when you look closer.
Like the same restaurant sales number.
Exactly, a solid 3.5% increase there. And maybe even more important, same restaurant traffic actually flipped positive, up 2.0%.
That's a critical inflection point, especially, given the backdrop in casual dining where traffic's been pretty choppy for a lot of players.
Totally, and system-wide sales hit $346.2 million. Plus, they hit a big milestone, their 600th system-wide restaurant.
Which tells you about the pace of growth. They opened 17 new spots and acquired 19 franchise locations just in Q2. That's a lot of activity.
Seriously aggressive expansion. So let's dig into what management actually said about all this, starting with that traffic turnaround you mentioned.
Yeah, they really leaned into that. They didn't just mention it. They highlighted fiscal June specifically, called it the best monthly traffic growth in over 2 years.
And they sound pretty confident it's going to continue for the rest of 25.
Well, look at the holiday performance, right? Mother's Day was apparently their busiest day in 42 years. Record traffic, record sales.
Wow.
And then Father's Day also saw mid-single-digit traffic growth. So it suggests these aren't just flukes. It shows the potential maybe for even higher AUVs, average unit volumes down the road.
Right, especially with those new locations aiming for $2.7 million in sales by year 3.
Yeah, that growth engine is really firing. They're opening, more than one new restaurant a week on average?
That's the pace. And the target for the full year, FY25, is 62 to 67 new system-wide restaurants, mostly company-owned.
And importantly, these new units are apparently performing really well. Outpacing their initial financial targets, they're aiming for those strong economics, around 35% cash-on-cash returns.
Which is basically how fast they get their initial investment back.
Exactly. And over 18% return on investment, ROI. Those are solid numbers in the restaurant world.
So this fast growth brings up their real estate strategy. You mentioned something about second-generation sites.
Yeah, this caught my attention. It's basically taking over existing restaurant spaces instead of building brand new ones from scratch. Nearly 40% of their last 80 openings were these kinds of conversions.
Interesting. Is it cheaper?
Management says it's often faster to convert, and because landlords are eager to fill those spots, the net cost ends up being pretty similar to a new build. Plus, they're finding these high-visibility spots often turn into some of their highest AUV restaurants.
That sounds like a really smart, flexible way to grow quickly and maybe even, reduce some risk.
Seems like it. And their pipeline of over 130 planned sites has a lot of these second-gen spaces baked in. It supports that very ambitious long-term target of 2,200 locations.
Wow, 2,200. Okay. Let's shift gears a bit. Talk about costs. Q2 definitely had some headwinds there.
Oh, yeah. Commodity inflation was running at 8.1%. Key things like eggs, bacon, coffee, avocados, all significantly pricier than last year.
And labor wasn't cheap either. Labor inflation was 3.9%. That definitely fed into that margin pressure we talked about earlier.
Right. But there's some good news expected, right, on the commodity front.
Yeah, exactly. Management sees that easing up quite a bit in the second half. They actually lowered their full-year inflation guidance down to 5-7% from high single digits before.
And that's mainly because of eggs, isn't it? Supply getting better.
That's what they said, primarily improving egg supply. And what I thought was really telling was their decision not to add egg surcharges, even when costs were high.
Prioritizing the customer experience and maybe market share over just, patching up margins in the short term. That's a strategic choice.
Definitely feels like one. And labor inflation, they expect that to stay around 3-4% for the year. Seems manageable.
Okay, so beyond costs, what about the brand itself? Engaging customers.
Well, they talked about targeted marketing, especially in places like the Southeast and Southwest, driving market share gains. And this was interesting. Their customer base is getting younger.
Oh, how so?
Gen Z and millennials now make up the majority of their under 50 customers. They see this as a direct result of, their marketing, their menu changes, operational stuff, trying to stay relevant long term.
And the digital side probably helps there too, right? Making it easier to order or get on the wait list.
Absolutely. They're relaunching their whole customer platform, better wait list, better ordering, even adding things like geolocation for automatic check-ins when you arrive, just trying to make the whole experience smoother.
Makes sense. And it seems like they're also really focused internally on their employees.
Oh, massively. They kept highlighting their culture and development programs. And it shows in the numbers their employee turnover, both for hourly staff and managers, is way below industry averages, like several percentage points lower.
That's a huge advantage in this industry, where finding and keeping good people is always a battle. How do they manage that?
They mention consistent training, clear career paths, things like their certified general management program, and, focusing on work-life balance being breakfast, lunch only helps there. Building that internal talent pipeline seems key to fueling their growth plans.
Right. You need the people to run all those new restaurants.
Yeah.
And what about delivery? Did that come up?
It did. Third-party delivery traffic saw a, quote, material increase in Q2. They think it's because they optimized the program, like reducing some surcharges.
And crucially, do they think it's stealing customers from the dining room?
No, management seems convinced these are incremental visits, new occasions, basically not just replacing people eating inside, which is obviously important for overall growth.
Okay, so pulling it all together, what's the outlook? What do they guide for?
Well, this is key. Despite that Q2 EPS miss, they actually raised their adjusted EBITDA guidance for the full fiscal year 25.
Oh, interesting. To what?
The new range is $119 to $123 million. That's up from $114 to $119 million previously.
And that raise is mostly driven by?
Primarily two things. Those lower projected egg costs we talked about, and the contribution from the franchise restaurants they acquired that adds about $7 million net.
So that really signals confidence for the back half of the year, doesn't it? Even with the Q2 profit dip, they see profitability improving.
Definitely. They're sticking to their guidance for total revenue growth around 20% for the full year, with acquisitions contributing about 4 points of that. And they still expect positive low single-digit same restaurant sales growth and flat to maybe slightly positive traffic for the year.
And pricing. Are they jamming through price increases to help margins?
They seem pretty disciplined there. They took about 2.8% in July, and they'll have about 4% carrying over into the second half. It blends out to around 3% for the full year. They framed it as a long-term approach to offset permanent inflation, not just reacting week to week.
Got it. And the new restaurant openings?
Heavily weighted towards the back half of the year, especially Q4. So you'll see those contributions really start flowing through late this year and into 2026.
Okay. And they slightly lowered CapEx guidance too.
Yeah, just a touch, down to $152 million, mainly because they expect fewer ground lease openings in 25 and 26, which ties back to that efficient real estate strategy, using more second-gen sites maybe.
And one last signal of confidence.
They specifically mentioned seeing no slowdown in traffic trends in July. Plus, tariffs are basically a non-issue now, maybe 10 basis points impact for the year.
Okay, so if we put this all in context for someone thinking with the stock. First Watch is clearly in this major growth phase, opening lots of stores, but they're also juggling these margin pressures, at least in the first half.
Right. But that raised EBITDA guidance for the full year, combined with the positive traffic turn, that's the core of the bull case, I think. It suggests they see a path to better profitability ahead.
And the market seemed to latch onto that, at least initially. The story might be shifting, like you said earlier, from growth despite margins to growth with margins improving.
which historically tends to get restaurant stocks a better valuation multiple. So key things to watch now would be sustained positive traffic month to month.
Definitely. The Q3 earnings print will be huge. Commodity costs, especially eggs, but also produce. And can they actually execute on opening all those restaurants scheduled for the second half?
Yeah, and successfully integrating those acquired franchises while keeping traffic up without just relying on more price hikes.
In this environment where casual dining traffic is kind of all over the place, First Watch's strategy focusing on unit growth, getting traffic back, that value message like not adding the egg surcharge, it does make them stand out a bit.
Plus, that demand for full-service, quality breakfast and lunch seems pretty resilient. Hospitality matters.
Okay, so let's put on our imaginary hedge fund analyst hats for a second. Time for our This Is Not Financial Advice segment. Let's toss out a trade idea. Something a bit bold, but maybe plausible based on what we've heard.
All right, I'm ready. What's the big idea?
Okay, so the pitch is basically go long First Watch. The idea is the market is still undervaluing it because of those Q2 margin issues and the EPS miss. But the underlying story is actually getting much stronger.
So you're betting the market hasn't fully caught up to the positive signals, like that traffic inflection.
Exactly. Point one, traffic. It flipped positive. June was the best in years. July held up. It's rare right now. Point two, unit growth. They're expanding fast, 600 units, big pipeline, and the economics on new stores are great. That 35% cash on cash, 18% plus ROI. The second-gen site strategy seems to de-risk this too.
Okay, makes sense. And point three.
The commodity tailwind. Eggs getting cheaper is a direct boost to margins coming in the second half.
Right.
It directly addresses the biggest pain point from Q1 and Q2.
Right. And the fourth piece is the narrative shift you mentioned.
Yeah. As costs ease and all those new stores start contributing more revenue, the story changes. It becomes growth with margin expansion. That, plus the younger customer base, operational strength, it argues for a higher valuation multiple than maybe it has right now.
Okay, so where's the outrageous part of this plausible idea?
The outrageousness is maybe the magnitude. We think the market might be underestimating how much margins could bounce back and how sustainable that unit growth engine is. So the wild thought is, if they hit the high end of their raised EBITDA guidance and keep showing positive traffic,
Then.
could the stock realistically see, say, 30–40% upside over the next year or so as the market fully buys into this better story? Maybe retesting its old highs within, I don't know, the next couple of quarters? It's definitely something to think about.
A potential re-rating based on execution and easing costs. Got it. So wrapping this up then, First Watch's Q2 call showed a company growing fast, handling costs pretty strategically, and crucially, getting customers back in the door.
Yeah, and that raised full-year adjusted EBITDA guidance, mainly thanks to potentially lower egg costs. And those acquisitions signals real confidence for the rest of 2025.
Okay. And just the standard reminder, everything we discussed, especially that trade idea, is just for informational purposes. It's definitely not financial advice. Always, always do your own research.
Absolutely. Do your own homework.
Thank you for joining us on the deep dive today. We hope this breakdown was useful. Maybe mull over that question. Is the market missing something with First Watch right now? Have a great day.